Can't believe. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the U.S. just dropped a bombshell. I'm going to show you what the government is planning to do and why it means you may need to get out now. And is the Fed planning to cut rates in September? I'll show you why they're going to, and it has nothing to do with today's CPI report, but something much worse. And hedge funds are now deep short one sector of the market by the biggest margin since 2011. And when they do that, it means opportunity is knocking. Stay tuned. Now let's head over to Bloomberg, where we picked today's story up with a headline as we take a look at what's driving the markets in early trading today, as we see stocks halt their big rally as inline CPI fails to inspire. And right now, the market is fixated completely on the consumer price index, but they're missing a much bigger picture. We'll talk about that in a moment. The S&P 500 fell, led by losses in the world's largest technology companies, which are very sensitive to, of course, what goes on with the Fed. So many people believe when rates go down, it's really a boost for technology companies. Right now, the market's a little on edge, but not for long, because this has recently powered a big rebound in equities led by massive corporate share buybacks. Yields edge down, and swap markets, get this, continue to price in the first Fed move in September, which then caused the dollar to head toward its lowest level since March. And that makes perfect sense, not because the Fed has control over the dollar, because the market believes the Fed does, and that when a central bank cuts rate, it is bearish for currency. So what we're seeing here is exactly the market playing out based on what we saw in today's CPI report, but it doesn't mean the rally's over just yet, because what we can note is that looking back at prior Fed rate cuts, you can see coming into the dot-com bubble, the Fed didn't signal early on that they were going to cut, but the market started to price it in, and that sent equities higher, but not enough to make new all-time highs. In fact, it happened again in the global financial crisis as the market started to price in a cut. The Fed did, and then that led to a nice rebound in equities, but not one big enough, again, to recapture the all-time highs. And headed into the pandemic, the Fed cuts, the market has the same reaction. This time, it does break out to new all-time highs and takes off from there. And that's kind of the issue here the market's worried about. They're not sure what the Fed's going to do in September, but we're going to make the case of why they're going to cut, but not for good reasons. But if you want to get ahead of those hedge funds we're going to talk about later in today's show, well, we're going to show you exactly how our subscribers are doing that. We'll first look at machine positioning. We have two reports. One looks at how the machines are positioned across the broad equity, bond, commodity, and currency markets. And when the machines are deep short, it flags on our report buy signals that we share with our subscribers. But maybe you like to trade the technicals, those RSI and the MACD, but you find yourself getting in late, out early, and all over the place. Well, we take all those signals, aggregate them together, smooth them out with a proprietary overlay, and look at momentum across multiple time periods. And when we see large pullbacks and a shift in the daily momentum, well, that signals on a report as well. And you can get the two daily reports. You can get the tradable signals. Every signal it generates every day, yours. Plus, I go through every trade, give you my opinion on them. I give you my stop loss levels. I track all the trades and the returns. It's the good and the bad ones. And here's the best part. You can duplicate every single one. I know you can't do that with a lot of systems, but mine you can. We give you a weekly update on the stop loss levels. And here's the best part, 30-day free trial. You want to beat those hedge funds? Well, my subscribers are about to, and you can too. I'll show you where to rotate your portfolio into, because right now what we're seeing is people looking to get out of the fourth largest company by market cap, because now the government is threatening a very rare antitrust move and looking to break up Google. And this is a big problem for the markets, because again, you look at Google, they're the fourth largest by market cap, and they just mint money day in and day out. But one of the things they do with that money is they buy their stock back, and that pushes these major indices such as this S&P 500 and the NASDAQ 100 higher, because they are one of the darlings. That Magnificent Seven will look no further. You split them up, well, that means those revenues are likely to come down, and they're not going to be buying that much stock, suggesting that maybe now it's time for investors to get out, because the move would be Washington's first push to dismantle a company for illegal monopolization since the unsuccessful efforts to break up Microsoft more than 2 decades ago. Less severe options include forcing Google to share more data with competitors and measures to prevent it from gaining an unfair advantage in AI products. But is AI really that big of a deal? From what we know right now, they're just overpriced chatbots, but yet investors believe that this is going to be amazing technology that's going to drive revenues even higher on the back that companies are going to be able to get rid of workers. So far, the technology's not there yet. We actually asked this question a while back, and many of you commented that it wasn't that great. As the Justice Department's attorneys who have been consulting with companies affected by Google's practices have raised concerns in their discussion that the company's search dominance gives it advantages in developing AI technology. As part of a remedy, the government might seek to stop the company from forcing websites to allow their content to be used for some of Google's AI products in order to appear in search results. So yes, they are going to attempt to try to break them up, but they're going to do other things as well. And this is what was impacting the markets. It wasn't so much the CPI report, but if we look over here, this is a live look at Google right now. You can see, of course, QQQ down just a smidge, but notably Google at the time of filming down about 3% and weighing on the markets as investors really wonder this may be indeed the time to get out, because if the government does get away with this, well, it means Google's dominance in the search sector is gone, and also their big money manufacturing machine as well. But let's turn to the Fed now, as market is looking for a rate cut but didn't find it in today's CPI report. I'm going to show you why they are going to cut, but for reasons actually nobody wants. As core U.S. inflation now eases a 4th month ceiling, the Fed rate cut, the only question now isn't will they cut, it is how many times they will cut. Will it be just 1/4 point? Will it be 2, go a 1/2 point? But as I'm going to show you, it is not because of the consumer price index, it's because of something far worse. The so-called core consumer price index, which excludes food and energy, increased by 3.2% in July from a year ago, still now the slowest pace since early 2021. The problem is it's not as slow as everyone was hoping. They wanted to see it come down even faster, but one thing that's important to understand about the core CPI is it's very slow moving. It doesn't go as fast as when you see a big drop in energy prices as a headline CPI. So the fact that it's trending down is exactly what it should be doing. It's just not going as fast as policymakers might want. The monthly measure rose 0.2%, a slight pickup from June, surprisingly low reading. Economists see the core gauge as a better indicator of underlying inflation than the overall CPI. That measure also climbed 0.2% from the prior month, is now broken below 3% to 2.9 from a year ago. The Bureau of Labor Statistics said nearly 90% of the monthly advance was due to shelter costs, which accelerated from June. So this is a challenge now, but even though we note the shelter costs do come down, they're also very slow. Much just like the core CPI, it takes time. And it's not something that's going to rapidly move, but it will likely trend lower in the future. Inflation is still broadly on a downward trend as the economy slowly shifts into a lower gear, and we note that that is exactly what's been happening. In fact, we see that in the labor market. We hear that from companies saying, look, demand's going down and we're trimming another round of staff that we weren't really expecting to. So it makes perfect sense. As people have less spending power, then inflation will indeed come down. And combined with a softening job market, the Fed is widely expected to start lowering interest rates next month. While the size of the cut will likely be determined by more incoming data, well, of course, because we never know what the Fed's going to do until the time of that. But we do know the market tends to give the Fed a good indication of when it is time to cut. But now we're going to turn to the labor market, because what the Fed wanted to do is bring prices down. They wanted to curtail demand a little bit without harming the labor market. The problem is they're exactly what they're doing. They're damaging the labor market. And by September, inflation is going to come down. The Fed is going to cut, but not for the right reasons. As we take a look at the consumer price index shown in blue against total compensation, this is average hourly earnings multiplied by average weekly hours of production of non-supervisory employees. That in red and both on a year-over-year rate of change. And when you see total compensation grow slow, the natural effect is people have less money to spend, particularly when there are still increases in prices. Of course, we know insurance costs have gone up. We know oil prices are going back up, which means gas prices are going up. And we know that debt service costs are high as well, and that consumers are loaded up in that. So when you see a slowdown in total compensation growth, what you naturally expect is a slowdown in demand, which means consumer price growth slows. But what's important to note is that consumer prices follow total compensation with a lag. And you can see that almost in every instance. In fact, going into the global financial crisis, inflation took off. This really pinched consumers. And then next thing you know, inflation caught right back down with total compensation growth. In fact, you can see here in 2011, compensation growth started to slow. Inflation again went up, but that didn't last either. And now we're seeing a very long trend in total compensation growth decreasing as average hourly earnings are smaller. We're seeing less hours worked, and that is indeed pulling inflation down. And that is one of the problems, because what the Fed is going to find out is they just didn't pull back demand in a strong economy. What they did was break the labor market. And the evidence is very clear as we look at the consumer price index, still shown in blue, against continued unemployment claims, now that in red. And what you can see as, of course, demand goes away because people hit the unemployment line and stay on it, well, you get a natural decrease in inflation. Now, in the past, it was a lagged effect, but as we moved into more modern times, you see in the dot-com bubble, the two were almost perfectly in sync. The only difference then was we moved to the global financial crisis, is that energy prices took off, and that really hurt the labor market who couldn't afford them. And the next thing you know, we see again that inflation came crumbling down as more and more Americans hit the unemployment line. We see that heading into the pandemic, and we see it again now with the peak of inflation matching right in line with the bottom of continued unemployment claims, making the weekly data on continued claims the most important data series to watch. Of course, we'll follow up on that in tomorrow's show when we get the data, as we do every Thursday. And investors and policymakers alike will find the report mostly good for markets and the economy, and indeed they did. We saw in early trading markets sell down a little bit but rallied back. And as inflation decelerates, the Fed can legitimately cut rates yet keep policy restrictive overall. And that's the hope, is that markets actually believe in the soft landing narrative. They're buying into the fact that consumers are delaying their purchases, which we talked about in yesterday's show, that perhaps the Fed's target of a soft landing in the middle of the year is just a little off by perhaps a few months. The reality is we're seeing an unwind, a very slow one, in the labor market, and that's the dangerous signal here. There's something the Fed did not want. And before their September meeting, officials will get more inflation readings plus another jobs report referring to the non-farm payroll, which will be heavily scrutinized after the disappointing July figures helped spark a global market sell-off and fanned recession fears. But the problem is, where the weekly claims go, it tells us that non-farm payrolls are going to follow. Because what's key here is the U3 unemployment rate is actually leads the non-farm payroll report. So we look at the continued unemployment claims, will lead the U3, will lead the NFP, and what you find out is where the claims are going now suggests that the Fed is going to be forced to cut, and not for the reasons they do, is because they broke the labor market. Here you see the U3 unemployment rate in blue against continued unemployment claims, and it's very clear where continued claims go. You can see in each and every instance the U3 follows, and where that goes, the non-farm payroll report goes after it, which sets us up for a very disappointing non-farm payroll report coming into September. That will be for, of course, the August data, and that means the Fed will cut, but it also means it'll be too late for the U.S. economy that's likely to be heading into recession in the holiday season. The most disappointing part of the report was shelter prices, which economists and policymakers have been widely expecting to ease and help move inflation closer to the Fed's target, and it will. It's just not very quick. Shelter, the largest category within services, jumped 0.4% after a 0.2% increase in June, which was the lowest since 2021 and thought to be the start of the long-awaited slowdown. Within shelter, Owner's equivalent rent, the biggest individual component of CPI, also rose 0.4% as rent of primary residence climbed 0.5%, the most in February. But again, these one-off month-over-month prints do not change the downward trend in the consumer price index, but something is going to validate everything about the U.S. labor market also was buried in that report, because a separate report today combined the inflation figures with recent wage data that showed that real or inflation-adjusted earnings growth decelerated by 0.2% in July, and that meant the year-over-year rate of change went down. And all that indicates is that consumers are not keeping up with inflation, something we already know is happening. And what that means is, again, the U.S. economy now squarely headed into recession. The Fed will indeed start to cut, but they're going to do it because the labor market's going to fall apart. And no matter what the Fed does, it's not going to change the path, because once you start to see continued claims spiral out of control, well, a couple rate cuts isn't going to fix it. But in the meantime, there's a huge opportunity lining up as we see now, of course, bond traders are trimming their bets on a Fed rate cut after the inflation data, and they trimmed it back a little bit. But as we look to the market to determine where the Fed's going, we follow up on two-year Treasury yields against the federal funds rate, that's shown in blue, and we can see two-year yields lead the Fed every time. Now what we're seeing is two-year Treasury yields starting to break below their prior low that the Fed ignored and continued hiking into. And alone, just based on the 2-year, what we're seeing, that is, from the market, is they're telling the Fed, look, you need to cut. The only question is, will the Fed cut by 25 or 50 basis points? We don't know yet, but we do know when interest rates go down, it means financial conditions tighten. It's not good for the labor market at all. It doesn't mean consumers are going to go out and spend. It means we're squarely now, again, as I said, headed right into recession. But that still sets up opportunity, as hedge funds are now massively short and they're bearish on commodities as since at least 2011. This is their biggest position since then. And of course, our subscribers, as I noted, and you can get access to that, links in the description below, are setting up some crazy big potential returns here, as hedge funds are the most bearish on commodity prices in at least 13 years, as fears of a deeper economic slowdown cast doubts on demand for everything from crude oil to metals and grains. And money managers piled a combined net short position of almost 153,000 futures and options across 20 raw material markets in the week ended Tuesday, according to the CFTC data. And that's the most on record based on figures going back to 2011. And when you see a massive short position, well, it should be opportunity knocking. Again, all you have to do is look to our reports, because we've been flagging a bunch of trades on commodities to our subscribers. And here you can see money managers' net position on baskets of 20 commodities, now the deepest since 2011. And future speculators are short for good reason, said Bloomberg Intelligence, as they note rising supplies of energy and agricultural commodities amid declining China demand and a stronger dollar as solid price headwinds. But keep in mind, despite the fact that they see a bear market, if the Fed cuts here, that means the dollar goes down. That could be a huge boom for the commodity space. And here what we can see is a Bloomberg Commodity Spot Index, which tracks futures of energy, metals, and ag commodities, has fallen almost 11% since 2024's high in May, setting up an opportunity. Remember, you want to make money in the markets, you got to buy low and sell high. Go check that out. And then while you're there, grab a subscription to our reports, because we show you which ones to buy. Because even look at the energy markets, as bullish position oil just hit an all-time low, signaling a price rebound. And that's usually what happens, is when bullish positions back off or you see big bearish positions, the market tends to move in the opposite direction. And sure enough, today we still see demand for energy as West Texas Intermediate extends losses despite Cushing stocks tumbling to 6-month lows. Remember, those bullish positions are being unwound. But look at this, crude inventories up a mere 1.36 million barrels. But how about this? Gasoline inventories down almost 2.9 million, and distillates down almost 1.7 million. So there's clearly a sign in demand for the energy sector, indicating perhaps the hedge funds on the wrong side of the market, setting up a big possible move. Check it out. Again, links to the description below for a 30-day free trial for our reports. But in the meantime, look for the Fed to cut and keep an eye on Google, because if the news starts pushing more that they're going to break up the company, watch for that stock to drive the major indices lower. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.